Hello, my name is Connor, and thank you for watching my thesis presentation. The title of my thesis is Finding Wisdom in the Crowd, How Stock Market Returns Can Be Effectively Predicted Using Twitter Sentiment and Past Return Data. Before I begin, I'd like to thank my mentor, Dr. Zimbra out of the MIS department, and Dr. Koo out of the finance department. So a little bit of background about this field before we dive in. The main reason I was interested in pursuing this was because there's been a lot of previous studies that have shown very impressive results in using Twitter sentiment to predict stock returns. And additionally, on the finance side, I wanted to investigate the efficient market hypothesis and sort of test the veracity of this against Twitter and see if we can't prove the market's inefficiency. Additionally, since these studies that I just referenced have come out, individual investing has become a lot more popular, and it's become very common to use Twitter to talk about companies that people either like or don't like using the hashtag syntax we see here on the right via the $ and the stock ticker. So these two things give us the tools to investigate the efficient market hypothesis and try and build off previous studies in the field. I chose to use the Dow Jones from September of last year to January of this year because it's pretty well diversified across almost every sector and one of the most commonly talked about exchanges. I used Tweetbee to pull tweets for December and January. And the reason for this was because Twitter's free API only allows you to do a keyword search for up to a week in history. So after I finished doing this in December and January and had a good basis of tweets, I searched through every user that I had scraped and looked for all the relevant tweets about the Dow Jones companies back to July. This is obviously an imperfect approach, but given the constraints and the fact that I was still able to find 465,000 tweets for my data set, this sample size was large enough to proceed and continue on. Once I had my tweets, I used the natural language toolkit to remove stop words, and I did add some back that had particular relevance to finance to the study, like the VIX and EPS, for example. And once I had the relevant words, I tokenized them and built a term frequency inverse document frequency matrix to move on to classification. So to build the classifier, I manually classified 1,000 of the tweets as negative, neutral, or positive. The neutral class was a lot in the majority, which led to some bias in the classification. So to fix this, I upsampled the minority classes and then tried again with the classifier. The best classifier I found was a support vector machine, and here's some sample results on the right using a test size of 0.2. As you can see, a accuracy score of 87% and a precision and recall score that were also fairly high were encouraging and good enough to proceed. And then using cross-validation, I tuned the hyperparameters and then retrained the classifier on these 1,000 tweets to predict the rest. Next, I created a bullishness index for each company for each day. The formula here on the bottom is what has been used in the field previously, which is the bullishness score is equal to 1 plus the number of bullish tweets over 1 plus the number of bearish tweets. And I did use this initially. However, I found greater effectiveness in building a predictive model when accounting for the number of retweets in each for a tweet, which intuitively makes sense because if we're talking about using sentiment on Twitter to sort of gauge the whole market sentiment, if that tweet's getting dispersed more through retweets, it likely would have more of an effect. So I modified this a little bit to be 1 plus the summation of all of the bullish tweets using a weighted sentiment of each one as the absolute value of 1 plus the number of retweets times the sentiment. And then the same thing on the bottom for negative tweets, and using my bullishness score and the index, the final step was to download the return data and build the model. So I used Yahoo Finance for this and then split my data set into a training set prior to this year and then test set of January. Next, I looked at the correlations, which you see here on the bottom. This gave a good starting point to build a model with the independent variables that were most significant. I began using regression analysis, but classifiers ended up having the best results. So I created dummy variables of ones and zeros to represent an increase or decrease the next day, and landed on a logistic regression model, which was used to inform a strategy of buying or selling based on the predicted results for the next day. And here are the results for the month of January using the logistic regression model. I generated a 0.84% cumulative return for the month versus the market return of 0.61, which when using a paired t-test led to a 7% statistical significance level, which was very encouraging. And although it was not as high, or excuse me, not as low as some other studies in the field have shown, this was still a satisfying result. Looking at the bottom graph, we see that after the first few days, the model consistently beat the market and remained cumulatively above it, which was good to see and representative of our low p-score. And looking at the right, we see that the market's average return was, the model's average return for each company was higher than the market's in 20 to 30 days, which was also very encouraging. So that's all I have for you today, and thank you for listening.